Welcome back to the VA Loan Masterclass series. Today's video is going to be on a part of the VA loan qualification that almost nobody explains to veterans before they apply. I'll give you a hint. It's not your credit score, it's not your debt to income ratio, and it's not your income history. It's a little something that we call residual income. And it's one of the main reasons that the VA loan has one of the lowest default rates of any mortgage product in the entire country. In today's video, I'm breaking down what residual income is, how the VA uses it, what the numbers actually look like, and why understanding it can make a real difference in how you approach your loan approval. If we haven't met yet, my name is William Ware, the Loan Cat. I'm a GWAT veteran, currently still serving in the Army Reserve, and for the last few years, I've been a mortgage broker specializing in VA loans. And this video is part of my VA Loan Masterclass series where I'm breaking down the VA benefit in English. So let's get into today's video. Here's what we're going to cover: what residual income is and where it comes from, how the VA calculates it, and what the minimum thresholds look like and why they vary, how residual income interacts with debt to income ratio, and what veterans should know about residual income before they ever even sit down with a lender. So let's start with the basic concept. Most mortgage programs qualify borrowers primarily around two things: credit and debt to income ratio. Those are the dominant filters. The VA uses those two, but it adds an additional layer that most other loan programs never require. And that layer is your residual income. The residual income is the amount of money that you have left over each month after all of your major monthly obligations have been paid. So it's not just your housing payment, and it's not just the debts on your credit report, it's all of your debt that you pay every month. The VA wants to know that after you pay your mortgage, your taxes, your insurance, your debts, and your estimated living expenses, that you're still gonna have money left over to support your household. That is a fundamentally different question than what most other mortgage programs even ask. Most mortgage programs are only gonna ask whether your debt payments are low enough relative to your gross income. The VA takes it a step further and asks whether you actually have enough money left to live on after everything is said and done and paid for. That distinction is why the VA loan performs so well over time. It's not just qualifying borrowers, it's qualifying borrowers who can realistically sustain the payment on the property. So here's how the VA calculates your residual income. The lender starts with your gross monthly income. Then they're going to subtract your proposed monthly housing payment, which is made up of your principal, interest, taxes, insurance, and the VA funding fee if it's being financed, as well as any HOA or community association fees. Then they subtract your monthly debt obligations from your credit report. Then they subtract a maintenance and utilities estimate based on the square footage of the home. What's left over after all that subtraction is your residual income. Now, that number is going to be compared to a VA regional threshold based on where you live, your loan amount, and the size of your family. The VA divides the country into 4 regions: Northeast, the Midwest, the South, and the West. Each region has different thresholds because the cost of living is different in different parts of the country. Family size matters too. The VA's residual income table accounts for households ranging from 1 person up to 5 or more. A larger family has a higher residual income requirement because more people need to be supported on that remaining income. So here's what the thresholds look like in general terms. For a loan over $80,000, which covers almost every purchase in today's market, the residual income requirements for a family of 4 range roughly from the mid-900s to over $1,000 per month, depending on the region you fall into. These numbers do get updated periodically, so your lender will have the current figures for your specific situation. But the point is that the VA is not looking for a token amount left over, it's looking for a meaningful cushion. Now, here's where it gets interesting, because residual income and debt to income ratio interact in a specific way that veterans need to understand. The VA's guideline for debt to income ratio is generally 41%, meaning that they don't want your total monthly debt payments, including your new housing payment, to be more than 41% of your gross monthly income. But if your debt to income ratio is above 41% and you still meet or exceed the residual income requirement by a meaningful margin, that can be a compensating factor that supports your approval anyway. In other words, residual income can help offset a higher debt to income ratio if the numbers make sense. Now, the logic makes sense. If your debts are high relative to your income, but you still have well over $1,000 left over every month after you've paid all your bills, you may be a better real-world credit risk than someone with a lower debt-to-income ratio, but almost nothing left over after they make their payments. The VA is trying to measure actual financial sustainability, not just the ratio. And here's where veterans sometimes run into issues with their residual income. The first situation is large families with moderate incomes. If you have 4 or 5 dependents, the residual income threshold is higher, and the math has to work. A moderate income with a high housing payment and a large family may not leave enough residual income, even if the debt to income ratio looks fine. The second situation is high cost of living areas. The VA's maintenance and utilities estimate is based on square footage, but it is a fixed calculation. In markets where actual utilities and living costs are significantly higher than the national baseline, the residual income calculation may not fully reflect the real financial picture. That's something worth discussing with your lender. The third situation is borrowers who are right on the edge. Your residual income is close to the threshold, but not comfortably above it. The underwriter may want to see additional documentation or other compensating factors, aka a larger reserve account, a history of successfully managing similar payment levels, or other financial strengths that can help support the file overall. But here's the reality check. Residual income is a feature of the VA loan. It is not a hurdle. Some veterans hear about this requirement and they worry that it's just going to be another obstacle between them and getting approved for a house. And that's the wrong way to think about it, because the residual income requirement exists because the VA wants veterans to succeed as homeowners, not just to close, but to actually be able to sustain the payment, support their family, and not end up in financial distress 6 months after moving in. A lender who understands residual income can help you structure your purchase in a way that makes the numbers work. The right loan amount, the right price range, and the right time. And that's the value of working with someone who actually knows the VA loan qualification process functions at every layer, not just the surface level. So let's sum everything up today for the video. Residual income is the money left over each month after your housing payment, debts, and estimating living expenses have been paid. Then the VA compares the number against a regional threshold based on where you live and how many people are in your household. It then interacts with your debt to income ratio and can serve as a compensating factor when DTI is above the guideline threshold. Now, the most common challenges involve larger families, higher cost of living areas, and borrowers who are close to the threshold. And understanding residual income before you ever even apply helps you work with your lender to structure the right approach from the very beginning. If you're a veteran and you're getting ready to apply for a VA loan and you've never had a lender walk you through the residual income calculation on your specific numbers, that's a conversation worth having before you're under contract. The next video in this series is going to cover something that a lot of veterans don't even realize is possible: carrying 2 or more VA loans at the same time. It happens a lot more than you think, and the rules around it are definitely worth understanding. So I'll see you on the next hole.